Hi everyone and welcome to the channel. Today we're gonna talk about 5 habits keeping you poor. But before doing so, press the subscribe button down below and join the community. Number 1 in our list is the lack of financial education. Money is absolutely crucial to build up wealth. Nevertheless, most of the people simply lack of financial literacy, leading to poor money management and ultimately to overspending. And let's be honest, most of the people around us live paycheck to paycheck, just to make ends meet and to pay utilities, basic food and so on, without saving that much. In terms of overspending, Robert Kiyosaki in his book Rich Dad Poor Dad said something extremely wise, that rich people tend to buy luxuries last, while poor people and middle class tend to buy luxuries first, because they miss temperament and they would like to boast off a lifestyle that they cannot afford with their own means. Ultimately, they end up broke. Overspending leads to a never-ending loop of earning and upgrading, and this basically is absolutely detrimental for financial independence. This kind of pattern can also impact the social circle, amplifying the overall spending cycle, because whenever we earn more, also our friendship will change according to our new lifestyle, and we will feel the pressure of keeping up also with the people surrounding us. But what does it mean in substance? So, long story short, to become rich, you have to learn how to invest and how to acquire assets, or things that put money in your pocket. Working on yourself to get rid of the poor and middle class mindset of investing in that kind of education that is just useful to get the skill to get a job and to work for somebody else. In simple words, the wealthy understood how to buy assets in order to provide passive income that fuels their capital position, generating a positive cycle, whereas invested money are able to generate more money, in contrast to middle class people that usually can have just a steady income from their job position. Plus, consider that whereas the rich invest in assets that generate cash flow into their pocket, the poor and middle class tend to spend on liabilities, which detract money from their capital and on average depreciate over time. But now you can ask me what I define as an asset. Well, asset can be a broad range of things, but just to make a few examples, we can mention stocks, bonds, commodities, precious metals such as gold and silver, real estate and so on, but also patents and copyrights. So even writing a book is not a bad idea to generate a passive income stream. The amazing thing stemming from buying assets is that over time the interest generated by these investments compound, increasing exponentially our profitability generation potential. Another aspect of financial education is that it gives us the tool to understand what is good debt and bad debt, and gives us the instruments to use debt in order to build up wealth over time. Looks crazy, but it is true. Let me make a few examples. For instance, consumer debt for the purchase of a new car is not tax deductible. So whenever it is underwritten by a natural person, there is no way that the purchase price can provide some kind of tax shield. On the other hand, if the same purchase of the car is protracted by a company, the entire amount of the debt is tax deductible, including the interest payment, making the acquisition of a new car potentially a zero-sum game. If you would like us to provide a dedicated video on how to manage income tax, let us know in the comment down below. Here we come with the bad habit number 2, which is relying solely on job income. So relying solely on one income source sounds quite ordinary, but we can define it as extremely suboptimal because limits your financial growth. Plus, it makes you absolutely vulnerable to the bargaining power of your employer. In this light, we can identify two kinds of people. The kind of people that feel comfortable of having a 9-to-5 job 5 days a week, without taking responsibility of their own decision and without taking any business risk, and these people is usually fine with a steady but limited stream of income. So low risk, low reward. And another kind of people that are more risk seeking and by their own nature more business oriented. This second type of people has the possibility to reach financial independence, while the first type of people simply doesn't. Full stop. No way. Sorry. Taking calculated risk is then essential for our financial growth, because staying in our comfort zone with a steady stream of income simply doesn't allow you to have financial success in the long run, even if it may look secure, of course. So just to summarize, it is all a game of risk and reward. How much risk you are willing to take and how much reward you are expected to get. The more the risk, the more the reward. And this is absolutely clear whenever we listen to all these people and they say, yes, but I'm not interested into having more money, but then they complain about the 9 to 5 work 5 days a week. From my personal standpoint, that behavior is just a rough justification for their inability or their unwillingness to take risk. So basically they are risk averse and they would like to stay in their comfort zone. The third bad habit is having a fixed mindset. A fixed mindset can seize your ability to recognize opportunities and limit your financial growth. In these slides, it is absolutely pivotal to work on yourself to become as resilient as possible and able to face all the multiple circumstances in life that will pose a challenge to you. We have to become resilient by learning and adapting. Just to quote Ridelio, we should embrace failure and pain as a source of experience, because from pain we have a full set of second-order consequences that will give us the ability to face life in a better and more efficient way going forward, bringing us to success. From a personal standpoint, it is absolutely necessary to set our goal way in advance, in order not to lose from our sights what is the final objective. This way we can keep going without having too much worry about momentary success. Plus, we avoid the event of remaining stuck in a cycle of financial mediocrity. The fourth bad habit has more to do with pride. So not taking responsibility about our financial situation. So my personal suggestion, if you would like to reach financial independence, is to take full responsibility of your financial decisions. And most notably, to learn from the outcome of those decisions. Simply because blaming external factors for your financial success doesn't bring you anywhere and doesn't teach you absolutely anything. Plus, won't lead you to a positive change. In substance, your life should be a temple of continuous learning. Clear, right? And here you have it, the fifth habit that might be keeping from financial success. That is doubting of yourself. Just to quote Robert Kiyosaki in his book Rich Dad Poor Dad, it is not what you say out of your mouth that determines your life. It is what you whisper to yourself that has the most power. And this highlights the importance of self-belief and positive affirmation in shaping your financial reality. So we reach the end of the video. I would like to thank you a lot for staying with me until this point in time. But before you leave us, press the subscribe button down below, the thumb up and the bell to support our channel. And on top of the book written by Robert Kiyosaki, Rich Dad Poor Dad, I will suggest this book, Irrational Money, written by myself, in order to exploit behavioral biases on the stock market. Cheers!